Traditional mortgages are so outdated. If you're self-employed or an investor, non-QM loans right now are all the rage. They're not risky, they're realistic. A non-QM loan could be the difference of you being able to acquire wealth through real estate or just getting denied over and over again. I'm Andrew Russell, owner and founder of RCG Mortgage. I specialize in helping home purchasers buy the house of their dreams, or those looking to refinance, save money, accomplish their goals, and improve their financial position. One of our clients was actually referred to us from a top real estate agent who had a client that was getting denied over and over again, but wanted to buy a $3 or $4 million property. He was a straight up gangster. And no, I don't mean an actual thug. Duh. He actually owned one of the biggest distributors in the Diamond District in Manhattan in New York City. He was making tons and tons of money. He was the guy you call when you actually have something happen in, say, South Beach in Miami, and one of these big events, right? And you call the guy who comes with the Rolex that nobody can get, and he gets the Rolex somehow, not sure how. And, he would go there, he would tell us, and he would make, $30, $40, $50,000 every handful of hours selling these things. He would murder it, but that's the type of business this person was in, and he was killing it. But he kept applying at all the big banks to buy a $3 or $4 million property. He wanted to put down, call it 30%, which is actually a great down payment. And he's getting denied over and over and over again. Why? We've said it before, because he's being put into the wrong mortgage type. The type of mortgage the big banks actually only offer where they don't offer the right one, which is non-QM. We did look at his tax returns. We wanted to see where it all went wrong. I've never seen so many zeros for revenue in a business, and he owned multiple businesses in a similar industry, obviously in the Diamond District, but the net profit, he was showing a gain of $100,000 for the year, or he was showing a gain for $80,000 after all the expenses. So of course you can't buy a $4 million house making $100,000 net profit off your tax returns. So I said, hey, listen, let's take one of these businesses. Which one has the most amount of revenue coming into your business checking every month over the last 12 months? Let's call it ABC. So he sent us the last 12 months of the bank statements for the company, let's call it ABC Diamonds, and we saw every month was over $1 million in business deposits. So the tax return showed a net profit of $120,000 for the year. That's what it was, I believe, which is $10,000 a month, which again is never getting the job done for a $3 or $4 million purchase. Now, the business bank statement that showed $1 million a month, every single month in deposits, we instantly, no questions asked, can give him credit for half of that for income. So follow. Instead of $10,000 a month in income, half of $1 million is $500,000. His monthly income went from $10,000 to $500,000 a month of income. I don't have to tell someone that has to specialize in math or, is a master at algorithms. Clearly, you're going to qualify for a lot more, making $500,000 a month in usable income versus $10,000 a month. So we were able to put him into this program. The interest rate was only 0.5% higher than what the current rate was on a conventional mortgage or a QM loan. And he easily, within 30 days, was able to qualify for the home of his dreams, 30% down, with a great non-QM loan based off of bank statements. Now, I can hear you now. Andrew, these programs are clearly so subprime. Like, what's the catch? There's something wrong going on here. No, it's not the truth. It's a 30-year fixed rate mortgage where income was based off of the deposits versus his tax rate. Now, of course, he had phenomenal credit. He had in the 700s. He had 30% down, which is a lot of assets. He had a lot of money left over, millions and millions of dollars in multiple accounts. So it's actually a safe mortgage. It isn't something that's like a subprime, crazy, adjustable, no money down type program. It's a great loan, just better served for his mode of income. I can hear now as well, hey, Andrew, these have super high rates. That's not the case. Say the market rate at that time was a 30-year fix at, say, 6%. I remember he only got a 0.5% higher in rate. Now, again, it's the difference of buying or just renting forever. I think a 0.5% is a very fair number as a margin, but it isn't higher rate. It's not like the going market rate was 6% and the rate on this program was 12%. Or I could even hear you now as well saying, hey, Andrew, this is going to affect my credit and my reputation. Well, I can't speak to your reputation. That's your problem. But your credit, no, it's just a normal mortgage. So think a mortgage is a mortgage is a mortgage. If a 30-year fix, what's the rate? How do we get there? Is it QM? Is it non-QM? We got this client a non-QM loan. You got a 30-year fixed rate with a normal nationally regulated servicer who we made this payment to every single month. It's an amazing program, and without it, frankly, the self-employed community would be underserved. Now, let's break down what's true, what's not true about today's modern non-QM loans, because there's so much haterade out there, so much misinformation. Let's talk about the real tea and the stuff that's 100% inaccurate. So what's a non-QM loan? Who are they for, and what are the benefits? So a non-QM, or a non-qualified mortgage, is simply that falls outside the credit box or the income box or the asset box of a QM loan. Now, if you remember, a QM loan is a conventional loan, typically like a Fannie Freddie loan or an FHA loan or a VA loan or a USDA loan. So a non-QM loan is something where there's other ways we look at the income, other ways we look at their credit, other ways we look at their assets. And in that non-QM vehicle, they will qualify for a mortgage where maybe they didn't qualify in that QM type loan. So who is it for? It's for self-employed clients, like we've talked about, someone who writes off their income where they have a ton of money coming in, have a great down payment, a fantastic credit profile, tons of money left over in a rainy day fund, called for reserves. Reserves are how many mortgage payments do you have in the bank after you close. Typically non-QM loans, they want to see at least a year or more. So of course the risk seems low, but we're looking at bank statements for income instead of tax returns. Or it's for people that are 1099 contractors. We look at 1099s instead of Schedule C, or things that'll show expenses. It's for seasoned investors who want to buy an investment property, a 1 to 4 unit property. They want to buy a 5 or more unit property, maybe a mixed use, maybe a condo, with the magical acronym that you must know by now, DSCR, debt service coverage ratio mortgages. It's based on market rent. So if you're a seasoned investor with a great credit profile, 20% more typically or more down to purchase, instead of getting a private money or a hard money loan, which is really like a 1-year bridge loan with a super high rate, super high closing costs, and it's not permanent, you get a 30-year fixed rate mortgage and have a great, safe loan, and there's no cap on the amount you can buy. Why? It's based on the market rent. So for instance, an investment DSCR loan based on market rent. Let's use the example of $1 million sale price. $1 million sale price, if you put 20% down, an $800,000 mortgage with an interest rate of say 7%, it's about $5,600 a month for just the mortgage. Now, if you add in taxes and insurance, say taxes are another, $1,200, now you're $6,800, say insurance another $200, now you're at $7,000. If that $1 million property is a 4-unit, and each of the 4 units gets $2,000 in rent, that's the market rent. 2,000 times 4, of course, is 8,000. Now, 8,000 is higher than 7,000, which was the mortgage payment, so that investor would qualify. It's that simple. What is the market rent? Does it equal or exceed what your all-in payment is with tax and insurance? And of course, HOA if it's a condo. And if it does, you qualify. So it's perfect for the investor. It gives them a safe 30-year fixed rate mortgage, so they don't have to entertain some of these more risky loans when they're buying a property and they're going to rent it out. It's an amazing program just for them. So what are the benefits? The benefits, of course, if you're buying a primary house, that you can live the dream, live the American dream, and actually buy a house. But the benefits are, if you are a business owner and you write off all your expenses, typically you won't be able to qualify. You won't be able to afford a bike, You can qualify for anything. So now you could actually buy a property, and it's based off your revenue instead of your expenses. In the case, obviously, of the Diamond District purchaser, $500,000 a month of income we were able to use to qualify to buy a house versus $10,000 a month off his tax return. So these are the perfect mortgages, these non-QM loans that go off bank statements, maybe a profit and loss, which is just your revenue, your expenses, and your net profit on a piece of paper, or your 1099s, or maybe there's asset-based programs where if you have a ton of money, maybe 8 figures in the bank, but you're not showing a lot of income for whatever reason, we can lend based on that total asset amount. It's perfect for that type of demographic. Another benefit for seasoned investors, there's no cap on the amount of mortgages you can get. Now, typically Fannie or Freddie, I've seen them cap up to as much as, say, 10 mortgages, which seems like a lot. But if you're a seasoned investor and you're getting great deals over and over, instead of, potentially being a realtor and just selling it and making your commission, you can buy them and hold and retain and build wealth through real estate. So there's no cap on the amount of these type of mortgages you can do. And the benefit is you get a 30-year fixed rate mortgage, which is considered one of the safest loans that exist. So clearly these are all huge benefits, and that's why the non-QM space is exploding. So check it out. I put together a free non-QM loan guidebook. It actually has the top 5 non-QM mortgage types. It shows who qualifies for each and how to apply. Make sure it's actually in the description below. Make sure you click the link and we'll send it right over. So if you find yourself stuck in a traditional mortgage quicksand and you're just not able to qualify for the loan you're looking for, make sure you watch my next video. Bank statement loans explained. We're going to use visuals. We're going to draw out all the math. We're going to show you exactly what it takes to qualify for a bank statement mortgage.